There actually are some new people here, so I'm going to start off and lay a little bit of groundwork. We laid it the first time. Why are we all here? I'm here because I'm on a crusade. I think we can change the world with knowledge. And one of the things we're the most afraid of is finance. What do we do with money? And just people coming in, I want to know what to do with my money right now. I want to know what to do with my money right now. So it's, you know, it's sometimes a scary time. So we're going to talk a little bit about that, obviously, today. So this is what we started out with last time. You know, financial concerns are global. And you can kind of see a lot of similarity. We're all worried about it, whether we're in the United States or anywhere else on the planet. And it's quite consistent. Doesn't matter where you go. 3/4 of people don't think they understand how money works. And I think if we were honest, 100% of people don't understand how money works because there's just too many variables, right? This is what he was getting at a moment ago. Can everyone read that? So that should get laughs, right? That's what that should be. Because it's just as true in finance as in anything else. There is too much information, and the more information we get, the more confused we are. So what I'm hoping to do today in the second session, maybe it's it's the third session, sorry, is sort of get to some really good principles, and this is in dealing with the media's onslaught of information about investing. So the third session today is about investing, and that's the one where we all get sort of uptight about. So we're going to talk a little bit about how we can get out of the confusion by removing a lot of that information, because it doesn't matter. Most of that's noise, and we'll explain why. So does everyone remember that was here before what these two are? I'm not going to read this comic again. The idea is, with all that information, the only education we have was given to us at the feet of our grandparents and parents who lived at a completely different time than we did. There is no, and that's what this is saying, formal education in school. So when I was in junior high, I might have mentioned this, I had a 2-month, one quarter of a semester. So what's that? It's a month, not even 2 months. 1 month where I learned how to balance a checkbook. That was it. Nothing about how to look at a company or whether or not cash flow or nothing like that. It's just how to balance a checkbook. Didn't talk about debt, nothing. Did anyone else have a class in junior high, high school that had anything to do with personal finance? No. College. Anyone do anything in college? One. Checkbook balancing. Right. And then you graduate from college and they go, here's your job and here's that, health insurance and your this and that, and you pick. No education whatsoever. So what we are is we become prey primarily to our own emotions. That's what this is. We're optimistic, we're excited, we're thrilled, we're euphoric, and then, oh my God, anxiety, denial, fear, panic, capitulation, despondency, depression, hope, optimism, right? So there's a cycle. Things go really, really well in markets and media and the economy, and we feel great, and then things fall apart and we feel terrible, and we act on that, and we shouldn't act on that, right? There's a story, what do you call it, a parable of, did I do the 2-monk parable last time? I'll do it again. Do you remember it? Okay. So there's 2 monks, and they're looking at a flag flapping in the wind at the top of a monastery. And one of the monks turns to the other monk and says, it's the flag that's moving. It's not your mind. The first monk says, nah, it's your mind that's moving. It's not the flag. If you turn around, you imagine a camera is focused on those 2 monks, and they're looking up. You turn around, there's another monk sitting on a bench behind them, staring out into the expanse. And that monk says, kind of to himself, kind of laughing, he says, it's neither the flag nor the wind that's moving. It's your mind that's moving. Okay, so it's not the flag, it's not the wind, it's your mind. And that's the exact same thing I would take as a parable for all the stuff that happens in media. Right? It's all the things that happen are designed to take us off our game. The media knows, they do research, right? If this kind of music is playing in the background, it's going to make you want to buy this product. If this kind of music is playing in the background of the news story, it's going to make you afraid of this or excited about this. So they play the music, they make the colors correct, and all the research is there. And I know this because I have a 7-year-old and a 4-year-old. And they'll just follow whatever it says. If it says, and I don't know, do you guys know this? Do you know who Dora is? Dora the Explorer? I'm shocked. Does everyone have kids? Evidently. Otherwise, you should not know who Dora the Explorer is. So Dora the Explorer has been rebuilt, has been remade. Remember Dora's kind of short, squat? Now she's skinny and has a necklace and earrings. Can you believe that? Why? So they can make my 4-year-old want earrings and necklaces and skinny clothes again, right? That is the way media works. I mean, marketing and media and news, it's all designed to pull us off our game. And then you get Wall Street, and this is what Wall Street does. They're part of this crazy crowd right here. Wall Street creates a product that's designed to capitalize on what just happened. Because what just happened is what we're either excited about or afraid of. So in 2000 was the year that the most new mutual funds for technology came into existence. So that should tell us, that should be an indicator to us that that technology thing is about to blow up. Because that's when everyone started funneling money into it. They all marketed it. It all became the talk of the day. I had clients that came in our office and said, if you can't guarantee me 50%, I'm not going to do business with you. Oh, that's fine. You're going to go someplace else then, right? So media does it, Wall Street does it, and we are tied up into emotions and we have no education about it. This is something to be aware of, just where we start. So we need to shift. We need to shift how we think about these things. And I put these up in 3 separate slides and had a much broader conversation about these last time. But faith, patience, and discipline are the critical factors of personal finance that you won't read about in any kind of personal finance books. What does faith mean? You have to have a fundamental faith in the future, that it will eventually work itself out. And this actually is this is informed by an understanding of human nature. And I'm just going to lay it out very simply. Right? I want for my kids a better life than I had for myself. I'm willing to give up for my children. Most people I've spoken to would agree with that, right? And I know people that don't have kids that want to leave a better world. This is where environmentalism comes from. This is where, so many things come from this desire to leave a better place. Anyone a Boy Scout growing up? Girl Scout? I don't know if Girl Scouts taught the same lesson. So remember when you go to the campsite and at the end of the camping trip, what do you have to do?
Leave it better than you found it.
Right? We fan out, one person, and we walk through the campsite one way and the other way. We pick up every piece of garbage that was there, whether we left it or not, and we try to leave it better off. And we set up a tent. You'd try to do it in a place that wouldn't break the grass, because the grass doesn't grow back as well. We all want to leave a better place. So this better financial outcome leads to a greater happiness dividend, but in order to get there, you have to shift from the craziness and the velocity of media and trading and what's exciting and last year's performance and to faith, patience, and discipline. Okay. So those of you who were here last time know that we did a blueprinting exercise for about 45 minutes. Well, we talked about it. We didn't really do it here. We talked about cash management and some debt management. And today we're going to actually go into planning and then some legacy stuff. And planning involves trade-offs. We're going to take all the stuff we learned and talk about trading things off. Anyone know what that means? Kind of just a basic, okay? You can have whatever you want in life if you're willing to give up some other things, right? You have to be able to trade things away. So we're going to talk about trade-offs. Now remember when you were a kid? Right? Everything you owned fit into a box, right? Life was simple, right? And then you grew up. A lot more things, need more boxes, right? Simplicity went out the window. No more simplicity. Things got very complex. And then I had kids and I got more complex. So what is a comprehensive financial plan? It basically looks at all the things we talked about, puts them into place, puts them in order, prioritizes. This is what the textbook definition is, and this is my definition, okay? My definition is it's taking responsibility for everything that can go wrong so that we can have the joy of planning for what can go right. The 4th session today is legacy. What do we leave behind? And you'll notice when we talk about investing and talk about retirement income planning that the goal for me in retirement income planning is to have an asset base that all I ever spend on is the income. So that the date that I die, I have the largest asset base of my life. That way I have the opportunity to leave a legacy, right? And I have a coach, he's in Manhattan, and he's a business coach kind of guy. I've been reading his stuff ever since I got into the business. He was the first professional speaker I ever saw, an incredible human being. And what he tells us in the industry is he says, you should never take a client that doesn't share that. Because the problem is if you start dipping into your principal, it's end game. Right? It's only a matter of time when life gets more expensive, which I'm sort of getting ahead of myself here. Okay. So financial plan helps you define short, medium, long-term goals. So it does all these things, but you notice right here in the middle, trade-off analysis. So when you look at this in the big picture, what it lets you do is it lets you pre-experience what might happen. What if I commit, $5 a day to a Starbucks coffee? What if I don't? What does that leave in my pocket? How will that look 20 years from now? And it can make a huge difference, $5 a day, 20 years from now. And we're gonna look here in just a minute in that booklet that I handed out about some other things that people can use to kind of cut back expenses. So the idea here is goal priority. This starts with the idea that you can't have everything. I would love to take 6 vacations a year, live in a huge house, drive a nice car, send my kids all to great schools. I don't have the wherewithal to do that, right? So I have to make choices. So you prioritize. And this, frankly, we could do something like this in local government, state government, federal government. We could prioritize, and we could probably, eliminate a lot of the stuff that goes on. So what are those goals? I have 4 ideas. These are general categories of these goals. 1, they're possession type things. Buy the house, the car, vacation, these kinds of things. These are the lifestyle things. Second thing, and this is, when I'm working with people, education is one of the critical things. Right? Retire early. I'm going to work till I'm 75 because I'm actually already retired. Right? I absolutely love what I do. And if you find that, if you remember what Mike Van Horn talked about in the first time, is you love what you do, and you share that with lots of people, you can make money doing that. Why would you ever quit? Why would you ever leave that? Right? So I am retired. And the last item is leaving a legacy. And again, we're going to talk a lot about that in the 4th session today. So I want to look at this trade-off analysis. That's this page. And you can't really tell what all these things are, but the first one's a cup of coffee, 5 days a week, $4.50, $7, $8 a month. The next one, it's a BMW minus a Toyota equals $280 a month. So if you can commit to a Toyota instead of owning a BMW, it's $280 a month. Dinner for 2 twice a month, $170 saved. I know organic food is critical. I have so many people come into my office, and they're a couple. They spend $1,000 a month on food, not going out, but food that they buy. They buy it at the farmer's market. They buy it at Whole Foods. And I'm not going to tell anybody that they can't do that, right? I'm going to say that's expensive. That's an expensive option. So you could actually, as a lesser option, and probably less healthy also, you trade something away, right? Is look at Safeway Organics or other organic sources, or grow your own, right? There's all kinds of options. That saves $200. If you don't go out to lunch and buy the bento box, and instead you pack your lunch and bring it, you save $125 a month. If you think about your cable, your gym membership, the amount of cash you spend, $250 a month. And these are just, these are ideas that clients have come to me, hey, this is what I'm doing, this is how I'm saving money. So this is actually, these are tested. Go to the next page. Let's say you only do half of that. You save $550 a month. 8% average return, 20 years, that's $300,000. That's a good sized number. That's a good place to start. Hopefully you're already saving money before you start doing this. Yes, sir?
8% sounds really high.
Right now it does. Right? Long term. Mathematically. You know what? You know how I know that that's okay? Because compliance allowed me to say it. I should explain that joke, because some of these jokes are just for me. So in our industry, everything I say has to be pre-approved, which is obnoxious. Which is why down here you'll see, a lot of times you'll see a big thing that's got, and I'll sometimes go and read those and make a funny joke about what compliance made me say here. We can't really go into a comprehensive plan, right? We don't have enough time. Everyone has different issues. So I'm actually going to go into one element of a plan, and that's that retirement income. Because that is, when you ask, what are you afraid of, when Fidelity does a study or the FDIC does a study, what are you afraid of? The number one fear isn't death or taxes. It's outliving my money. So retirement income is the number one issue that people face when they think about their personal finances. How am I not going to run out of money? How am I going to have, and it's funny, but people do come into the office and say, I'm planning on dying when I'm 75. Well, how do you know that's going to happen? You don't have that option. So the question is, how do you transition from an earned income to an unearned income? And then how do you make sure that lasts? So what we do is we decide what your number is. We ask some questions to get to what is your number. So monthly income needed, $10,000. Does that sound high? The students all nodding. Yeah, that sounds really high. Okay. Well, I have a pension, Social Security, total of $2,000. So my gap is $8,000. Does that sound low to anybody? Okay. So what that means is in a year, you need a $96,000. Every year you need $96,000. Can you read that? How much money do you need to spin off that kind of an income every year, growing with inflation for the rest of your life? This is the interactive portion of today's presentation. What, did you say 1 billion? Is that what you said? It's a lot less than that, thankfully.
More than I wish it were.
True. So I should explain 4.5% withdrawal rate. That is, there is a range between 4 and 5% that works over a long retirement period. You get above 5%, you run out of capital. You're below 4%, your capital grows much faster, which is fine. But so 4.5% is a good mid-range. Okay, the number?
It's about 2 million. It's over
2.2 million. Someone's got a calculator, cheater. Okay. So let's say it's 2.2 million. So where are we now? And then how many months do we have until we need that capital? How much can we add every month? Or how much are we adding? Then how much can we add to that amount to get there? This is how we build that retirement income. We're just backing into what do we have to save. Okay, this is the most important challenge. Keep retirement income growing as the cost of living grows. So this is the biggest misunderstanding that I run into when I talk to clients. They think, and maybe in 1982 this would have worked. So remember, we all learn our lessons at the feet or knee of our parents and grandparents. And so we think we're planning based on their life expectancy and based on their experience during their lifetimes. How much did a CD pay us in 1982? Anyone have any idea? Some people must. 16%. Right.
When was that?
1982. That's before Reagan and Volcker broke the back of inflation. So that's nominal returns. That's not real. That's not minus inflation. That's your nominal return. You got a 16% return on your CD. Today, what's it paying?
1.
Sub 1. Nothing. So if you would have invested in a fixed income portfolio in 1982, that might have worked for 10 years because you got a lot of interest. But then slowly it would not work anymore. You simply cannot do it now. It will not work unless you have an incredible amount of money, right? So now we're getting into 4 epiphanies that if we take these epiphanies to the heart, if we really think about these, then it makes the decisions on how to invest really, really simple. Okay, the first epiphany is the answer to this question. What's the average? It's a combination of the answer to this question and the next question. What is the average retirement age in the United States? It's been the same for quite a while.
65, 70.
62. So the average person retires at the age of 62, which is shocking, right?
Yes.
Yes. 62. Now, this is the critical question. Does everyone know what a joint life expectancy is? So if you're partnered and there's a joint life expectancy, one of you will live X number of years. So one of you might die in the interim, but at least one of you will need an income this long. So joint life expectancy. Any idea what this might be? And you know what? I'll give you the answer, but don't trust me on this. Any of you that know someone in life insurance, ask them to look at their mortality tables for you and confirm this. You should burn this into your brain. 30 plus years, so 92. Joint life expectancy. One person, on average, will need 30 plus years of income if you retire at 62. This is something that's really important. So I'm from South Dakota. Has anyone flown through the Midwest? Anywhere in the Midwest? Okay. So if you fly through the Midwest and you get off a plane, what do you go into when you go into the terminal? So I have to use myself as an example because this is my hometown. I won't make fun of anyone else's hometown. So everyone there smokes, right? Everyone there, they don't exercise a lot, and they eat meat and potatoes. Okay, so they're not fit. They're not. So generally, the behaviors that we use out here in California are different. We are on the other side of that average. In general, our life expectancies are higher than most of the rest of the company. So if you've got 30 plus on average, I wouldn't plan for 30. I'd plan for 35 or 40. Okay, so because we have that long time frame, there is only one financial issue. And it's already up there, right? Inflation, right? Does that seem clear? 30 plus years, a single issue. Because if you have 30 years of retirement, 35 years, then your money's got to last a long, long time. What the market does this month, this quarter, this year, almost doesn't even matter, right? Does that make sense? So can you ignore Money Magazine and what happens in the media in terms of what's going on in the world? Can you ignore what's going on with Europe? Yeah, you can.
Short term.
Yeah, you can short term. The question is what's going to happen long term? It'll take care of it. It will be handled long term. There is no question about it. How is the question? Okay. So there's one long-term, rational long-term goal. Because that's the issue. So there's only one goal. One must. And I put this in green because I think it's important. It's not that you'd like to, right? It's not that it'd be neat if. One must create a lifestyle-sustaining income that lasts in a rising cost world for 30 plus years. That is the only goal when you're talking about retirement income. Nothing else matters. And look at this. I'm just going to let this sink in for a second. So basically this means in a 1-year period, bonds beat inflation 64% of the time, stocks beat it 68% of the time. Over a 20-year period, stocks beat inflation 100% of the time, T-bills and bonds. So the thing we're programmed to think is the safe investment is bonds. But look, safe means you don't lose principal. It has nothing to do with losing buying power. When you change the safety to reference buying power, bonds are the worst thing you can do. So the question is, what is risk? How do you define risk? I define it losing buying power. That's how I define it. If I define it that way, then that makes a lot of sense. Now, I want to back off for a second. We've just shocked the system. Back off for a second. Doesn't mean we go 100% in the S&P 500. That doesn't mean that at all, right? Because there's also the human factor. We're emotional about this stuff. We invest in 100% in the S&P 500. Next week, it goes down 80%. You know, that was wrong. You freak out. You're scared. You've lost 80%. You're done. So there's also this other factor is how do I stay invested? So I've got to have other pieces in there. And we're getting into session 3 here, but session 3, yes. I got to have other things in there to moderate the volatility so my stomach doesn't jump out. What this says is you can't, and we'll get right here. Boom, boom. See that? I put that right there, right? Because it depends on circumstances. It depends on everything. If my goal is to have the largest asset base in my life when I die, equities are the best tool to do that. But all I'm saying here is a fixed income strategy will not sustain your lifestyle in a rising cost world. Fixed doesn't work with rising. Square peg doesn't fit in round hole. That's all we're saying here. We're not saying how you build a portfolio. We're just saying we should be aware that inflation is the biggest risk. Okay. So that's why we said that there's basically one major investment decision, and that is how much you own and then how much you lend. There's really 2 options in investments: owning, lending. That's really it. Everything breaks down to those things. There's different kinds of ownership, different kinds of lending. It's owning and lending. The percentage of your portfolio you commit to owning great companies, social responsibly filtered, whatever you determine as great companies are, the higher the likelihood that your income will rise to meet your needs throughout your lifetime, and actually will surpass your needs so that date that you die, you have the largest asset base of your life. Okay, the reverse of that's also true. The greater the percentage of your assets you commit to fixed income investments, the lower the probability that your income will increase to keep up with your cost of living. Does that make sense? in the last 10 or 12 years, we've called it the lost decade. And we call it the lost decade because there's been no price appreciation from the S&P 500 or any companies, right? Where we were 10 years ago or 12 years ago in 2000 is where we are today. We've had crazy volatility between then and now, but we're in the same exact place. But are we in the same place? We're not. Because those companies have higher revenues, higher profits, better cash positions, pay higher dividends. So if you owned the S&P 500 in 2000, you would have gotten a $50 dividend on the S&P 500. Today, it's $80. No, sorry. No, that was earnings. So $50 to $76 or $84, depending on how you calculate it, earnings. Dividends went from $15 to $25. So your dividends, if you did nothing, your income increased. And we're talking about income, retirement income, portfolio, your income would actually have done what you wanted it to do in the lost decade. Because that's what companies do. So the story, the economic collapse, that's a story somebody is selling. And if you think about they're starting to deny the unemployment numbers and saying, well, there's this, I don't even remember what it is, but there's this other calculation that you guys are ignoring. And they're trying to make that part of the media. But they're full of it. Right? They don't know actually what they're talking about, but they're trying to get votes, trying to make us upset with where we are. That's media, that's politicians, that's Wall Street, that's not reality. There is no, my faith says, there is no end of the economic system. More people have come out of poverty under capitalism than any other system. Is it sometimes broken? Yes. Is it ultimately broken? No. Okay. I put this example up here because this is how we talked about it 4 or 5 years ago, right? You'd get a fixed income of 5% on your CDs or whatever for the rest of your life. You can't get that fixed income anymore. So I'm going to show that as the contra argument here, but it's not possible to get. Now it's $10,000 versus $100,000. There's no $110,000 option here anymore. Okay? If you have a $100,000 income in year 1, in year 5, to buy the exact same stuff, not increasing your, not going out to dinner more, not buying better groceries, not getting a new car, you need $115,000 to buy the same stuff. 30 years later, $242,000 to buy the same exact stuff that you bought in year 1 for $100,000. That is how inflation works. There's a really solid argument that can be made that we're going in for some, not hyperinflationary time like Zimbabwe, but major inflation. There's enough money pumped in the system, and I think that's coming. I don't know when it's coming. A lot of smart people think it's coming. A lot of smart people say it's not coming. So it's a good guess. Right now, there's another indication. This is CPI. There's another one that's American Economic Enterprise something. They say it's 8% today. They said if you actually look at a basket of goods that people buy, inflation's running at 8%. The old number, when you remove out housing and energy, it's only 3.3%, 3.2%.
If it's 8% versus 3%, what was it 10 and 15 years ago? So you can
Same.
do a whole trend.
Yeah, the trend is it's actually higher. When you look at that, it's the ERI, I think is what it's called. It's always been a little bit higher, right? And whereas if you have a fixed income of 5%, you continue to get that 110,000. So that's not going to work, right? Okay. So this is what we just said earlier. Diversified retirement income portfolio, the potential to outpace inflation. You have to have the potential to outpace inflation. That is, again, the risk. So if we look at that, and we look at, all we talk about is income. All we're concerned about is income. And the income increased, substantially from 1982 to the present. The benefit, and this is just, we didn't care about this. This wasn't our goal. But in 1981, the S&P closed at 122. In 2012, it closed at 1253. So, tenfold increase in the underlying value of what you own. Whereas if you had fixed income in the beginning, right, it'd be the same value. So your income went up 2.5 times. The underlying value went up tenfold. Now, I don't care if it goes up tenfold again. That's not what I'm investing for. I'm investing for income. But if you look at the media, financial journalism, whatever, you don't get this long-term what happened to the markets. What they talk about is what happened last month. In fact, what comes across my desk, people marketing products to us, is always about the last 3 months, 6 months, year. They don't talk about 10, 12, 15, 20 years. It doesn't enter into the conversation because they want to sell us on what they just did, which is what Wall Street does. They sell on what just happened because they're trying to prey on my emotions. So this is a simple question. Yes, you sure can. Absolutely. Can you do it yourself? You sure can. There's no reason you can't do this yourself. Anyone that knows how to run an Excel spreadsheet can do this. There are lots of online tools that help one do this if you want. The things you got to be able to do is you got to hold yourself accountable to decisions, right? So the biggest benefit that someone like myself provides is in the annual review, we come in and we say, okay, you said you were going to save $30,000 last year. How'd you do? Right? It's someone that holds you accountable to what you say you're going to do. Because we've written the plan. We know how much you need to save. Are you saving it? I'm not saving it. Well then, next year we have to save $31,000. We can keep going like this if you'd like, right? Okay. What are some of the things you look for? We have questions before hiring a planner. So this is it's not a new profession, but it's relatively new. Anyone can call themselves a financial planner. Right? It's not very difficult to hang a shingle and say, hey, I'm a financial planner. So there's some things you look for. These are the 4 things you look for. You've got to have some kind of education, taken an exam, some level of experience, and be ethical. Most financial planners, I'm not talking about brokers at Morgan Stanley, most financial planners are pretty ethical people. These are people that have done the CFP or the CPWA or the CLU or the CLUC, and this is the problem. There's 57 different designations that you're going to hear. But if they've taken education, you can look up what that, if they're CFPs, you can look up what's that mean. If they're CPWAs, you can look up what does that mean, because it's all online. There's two really good, the CFP is the obvious one. There's a group called IMCA at the Booth School of the Investment Management Consultants Association. It's out of the Booth School of Business in Chicago. It's another great group that has the SEMA and the CPWA that are good. So these are the questions. And when you ask these questions, it almost doesn't matter what the answers are. It's how they answer the questions, right? Make sense? The one thing I would say, and I'll say this all the time, when you're talking to somebody, when you're interviewing somebody, are you a fiduciary? Are you a broker or are you an advisor? I'm a broker. Goodbye. Right? Does everyone understand why that is? Do I need to explain that for anybody here? Okay? No one's nodding yes. Okay. You understood it? Okay. And that's the last page in here. Well, for now. So what do you get when you put all this stuff together, you think about the retirement income, all the trade-offs, you go through the whole process, you have a plan with all the pieces. And it's not what happens with, you can't plan for your retirement not thinking about your kids' education. Right? You can't plan how you're going to invest without wondering how much money you're going to need. It has to be all in one. Okay? Does that make sense? Right? Okay. I think that's time for a short break. But does anyone have any questions before we go on to the next thing? No questions? All right, let's take a quick break.